Ladies and gentlemen, once again, we're facing a scenario of major economic turbulence, and guess what, it's not a new script. Japan's finance minister Katsunobu Kato recently made waves with his increased sense of urgency towards Japan's currency, the yen, as it sinks dangerously closer to record lows amidst the dollar's ongoing global domination. Today, I'll dissect this unsettling development, shine a spotlight on the broader global financial environment, and of course, break down how policymakers seem to be throwing gasoline onto already smoldering economic fires. In recent weeks, the yen fell to 153.19 per dollar, a near 3-month low, and we're fast approaching levels that ought to make any government official lose sleep, particularly when you consider that earlier this year, it slumped dangerously near 162, hitting a 38-year low. The eyes of financial analysts and economists alike are glued to this one-sided and rapid swing in the forex markets, and let's not mince words, this kind of volatility is the last thing the world's third-largest economy needs right now. So, why this jolt of interventionist rhetoric? According to Cato, we're witnessing one-sided, rapid moves in the foreign exchange markets. Yes, that's a polite bureaucratic understatement for moments of pure chaos, and he's upping the ante with increased vigilance against speculative trading. But here's the kicker, beyond these surface-level warnings, Japan's Ministry of Finance, MOF, is seemingly straddling between panic mode and careful delay. Investors smell uncertainty, and they are rightfully concerned. Now, this all raises the critical question, why hasn't Japan stepped in with a currency intervention yet? Well, buckle up because this part is critical. Analysts predict that a firm step like direct currency intervention won't come unless the yen nosedives to about 160 yen to the dollar. But here's where the plot thickens, Japan's general election is just around the corner, and with the US presidential election on the horizon as well, policymakers appear cautious about any bold moves that might upset the delicate political landscape. To outsiders, this sounds like prudent governance. But if you look closer, it feels more like a high-stakes game of keeping up appearances. Remember when a sharp fall in the yen prompted monetary interventions in the past? Yep, that history taught us that governments only like to act when the problem becomes undeniable or when it threatens to ignite public unrest. So yes, the yen may be falling, but the political forces behind it are choosing to delay the inevitable, for now. And therein lies the dilemma, the longer these central authorities delay getting serious, the worse the problem could become. Remember, Japan's currency is already seeing significant speculative pressures. The more you signal to the financial markets that you're watching but not acting, the more likely market players, especially speculators, are to keep pushing the currency towards dangerous lows. Talk about throwing meat into the lion's den while hoping the lions aren't hungry. But let's not focus on the yen's immediate volatility only. What we're really witnessing is the symbol of Japan's deep-rooted economic ailments. Think for a moment, Japan, this is the same nation that's been grappling with stagnant growth, chronic deflationary pressures, and a mounting debt pile that continues to dwarf its GDP. The yen's rapid depreciation is a canary in the coal mine signaling much larger concerns. So, what are those deeper symptoms of Japan's economy that the yen slump reflects? For years, Japan has been wriggling out of the clutches of low inflation or outright deflation. In typical times, a weaker yen might be a blessing, potentially leading to higher import prices and pulling inflation rates upwards. After all, that's what central banks crave during low inflation periods, right? Wrong. Japan has tried almost every trick in the central banking playbook: aggressive monetary easing, think BOJ flooding the market with yen, negative interest rates, and even fiddling with yield curve control. And yet, inflation has remained frustratingly low for much of the last 2 decades. By the time Japan starts seeing any inflationary pressure again, a weak yen could spark this. It risks ending up in an economic vicious cycle within a global slowdown. Combining rising import costs with weak wage growth makes for a dangerous brew. Stagflation, where inflation is high but growth remains stagnant, may soon become Japan's next headache. Here's another reason to be skeptical of Japan's central bank leadership. The Bank of Japan, BOJ, now faces a damned if you do, damned if you don't dilemma. If public inflation signals pick up and the yen continues its dramatic slide, economists expect the BOJ to raise interest rates, potentially as soon as December or January. However, raising rates is like tightening a noose on the country's fragile growth prospects. Higher interest rates could worsen corporate borrowing costs, suppress consumer spending, and ultimately push Japan back into the abyss of economic stagnation. The tighter the monetary policy, the more damage to Japan's already stagnant demand. But on the flip side, allowing the yen to slip further without decisive action runs the risk of hyperinflation creeping in through import prices. Either way, the prospects aren't promising. In fact, data from a recent Bloomberg survey showed that most economists anticipate a rate hike coming soon, making Japan the latest among global central banks to hike interest rates in defense of their currencies. But Japan isn't the US or Europe. Its uniquely fragile economy means that any premature tightening could result in more economic harm than good. Just imagine walking on a tightrope, over a pit of inflation on one side, and a chasm of economic stagnation on the other. Ah yes, we can't discuss Japan's economic struggles without pointing to the elephant in the room, its aging population. Surging healthcare costs, limited workforce numbers, and shrinking tax revenues make for a fundamental burden that Japanese policymakers have been tap dancing around for too long. Combine this demographic crisis with ultra-low productivity growth. Japan's labor productivity is among the weakest of OECD nations, according to recent data, and you have economic stagnation in its purest form. This demographic time bomb exacerbates every other economic challenge. The government has been forced to increase public debt to finance welfare programs, pensions, and infrastructure, entrenching it in a cycle of borrowing with no real end in sight. Remarkably, despite having a national debt around 260% of its GDP, Japan manages to escape international financial wrath thanks to it being predominantly domestically financed. However, just picture this. If Japan boosts interest rates to prop up the yen, the massive debt repayment bill would spiral further out of control. An impossible choice, don't you think? Here is where the story interests not just economists but global investors and even ordinary financial enthusiasts. Japan's struggle with the yen is more than a local event, it can spill over into the broader financial system. Investors who are heavily invested in Japan may be scrambling for their risk-off trades, anticipating that further yen depreciation will lead to capital flight. A collapse of confidence on too dramatic a scale could wreak havoc on global market stability. Furthermore, let's put Japan's troubles in a broader context. In a world gripped by uncertainty, the sudden yen depreciation plays into the larger narrative of global economic power shifts. The USD's ascension, bolstered by aggressive US interest rate hikes and economic resilience, is sucking liquidity out of other economies, not just Japan. Emerging markets around the globe face similar pressures, as many focus on how their currencies fare against the ever-powerful dollar. A global financial dislocation could very well begin with Japan if leaders fail to act promptly. Ultimately, Japan's current economic fiasco serves as a glaring reminder of what happens when long-term inaction meets today's rising economic tides. The yen's fall is not a result of sudden change, but an ongoing symptom of decades of kick-the-can-down-the-road policymaking. Japan's chronic dependence on monetary policy to solve structural issues, mixed with a disjointed political will ahead of elections, reveals an economy struggling to respond to dynamic global conditions. The big lesson here is, whether you're a government, a corporation, or an individual, you're eventually going to have to pay the bill for long-term neglect. Japan has struggled to address issues like declining productivity, deflation, and ballooning debt for too long. And now, it faces a potential catastrophe with fewer tools in the arsenal. So as we keep an eye on foreign exchange markets and await Japan's potential response to the yen's decline, remember, this situation touches not just Japan, but the global economy at large. What unfolds here could reverberate across nations. It's an economic drama we simply can't afford to ignore. Ladies and gentlemen, we continue waiting to see if Japan finally hits 160 yen to the dollar and what crises may follow, whether in Japan or worldwide.